Hey everybody, in today's video, we're going to talk about how to lock in higher interest rates on your cash savings and why you might want to do that. We'll also cover why you might not want to do that. So in financial planning 101, everybody needs a little bit of cash set aside for a rainy day that's safe, that's liquid, that's available to them if something bad happens, okay? Some people call this a cash reserve, some people call this an emergency fund. It's very, very important. And the reason is that we don't want to have to dip into our longer term investments at an inconvenient time to pay expenses that might come up, right? And so here's the situation. Let's say that you're in the construction industry and you have a house and you have a family, you have kids, right? And you don't have an emergency fund. Well, you pay your expenses from work from your income from work, right? And everything's going soundly. You're making mortgage payments and everything else. No big deal. Well, what happens if the economy turns and you get laid off in the same month that the water heater breaks and you I don't know, twist your knee and have to have surgery on it and have to pay part of that out of pocket, and your kids have some big event for their sports team that's going to cost a couple $1,000s to pay for and go to the travel tournament or something like that, right? Well, your expenses are all stacked up against you, and you don't have a whole lot of cash to pay them at the same time that you might have just been laid off, right? So what we don't want to do is put those expenses on our credit cards and incur a whole lot of interest on them. And we don't want to have to dip into our longer term investments like our IRAs, like our 401ks, those accounts that are earmarked for retirement, right? Because guess what? A lot of the situations which might require us to use an emergency fund, like being laid off from work because of a bad economy, are the same situations that we might be at lower values in your 401k. It's the same situations that might cause a really down stock and bond market. Okay. So with your long term retirement savings, we're trying to buy low and sell high. Taking cash, putting it into these accounts, buying long term investments here, and then not touching them so they grow and grow and grow and grow. And you get this compound interest hockey stick kind of curve on your assets, because the longer that you're invested, the more of that compound growth, the more years that compound growth has to work to your advantage. But if you have to dip into it at an inconvenient time when values are lower, that just shoots yourself in the foot for 20, 30 years down the road. Future you is going to be upset about that. So everybody needs a little bit of cash set aside in terms of an emergency fund, somewhere between 3, 6, sometimes 9, 12 months worth of living expenses should be our emergency fund target. Now, today's video is about capturing high rates of interest on that cash. So once you have your emergency fund going, you have a little bit going into the bank for a rainy day. Maybe you have your emergency fund set up already. Where does it sit? It should not sit in your checking account. This isn't cash that you're using every single month to pay expenses. I mean, it might be realistically when you first start it. What you want is to park that cash in a high yield savings account that pays you a good amount of interest, is covered by the FDIC, and is liquid and available to you at all times. Those are the three rules for emergency funds. So in this environment, 4.5%, 5% is a competitive rate of interest on a high yield savings account. And if you're at a big bank that's only paying you 0.25, it's time to get that cash and put it somewhere else. Ally Bank offers a really competitive rate. Flourish is a company that our financial planning firm is affiliated, that offers 5% right now. And there's a litany of high yield savings account options out there. SoFi, Wealthfront, Capital One, a ton of good options. So when you have these higher interest rates, 5 years ago, interest rates were very, very low. Now they've come up quite a bit because of the economic and inflationary environment that we've been in recently, which means that interest rates are higher. We can get a higher rate of interest on our cash. So let's do the math on this. Let's say that you have an emergency fund of $50,000 and it's sitting in a Bank of America savings account that pays you 0.25% interest per year. That's $125 in interest. $50,000 of savings at 0.25%, $125 of interest per year. If you moved that into an account paying 5% interest, that's $2,500 a year, just by shuffling things around and capturing a reasonable market interest rate in this environment. So the point of today's video was, number one, to communicate that we need to scrutinize the rate that we're getting on our cash these days because it's a different environment than it used to be, but also recognize that we probably won't have interest rates where they are for that much longer. Guessing the direction of interest rates is kind of like guessing what's going to happen next in the stock market. So we don't know what's going to happen in the future for sure. That being said, we've come up with interest rates quite a bit over the last couple of years, and they've plateaued. And what will happen in the economic environment is that if inflation continues to go down and subside, which it has, I think, almost every single month for the last 18 months, maybe even the last 24 months now. I think there's been 2 months out of the last 2 years where inflation has not gone down. So we're in this downtrend with inflation. And if it continues in that direction, then the Federal Reserve might be inclined to reduce interest rates. If inflation goes up, they will not reduce interest rates, and they might even increase interest rates again to get a handle on inflation. So my point here is that at this point, it's much more likely that interest rates go down than it is that then they go up. So if you're having your emergency fund earn 4.5%, 5% because you're getting an adequate amount of yield on that cash, if interest rates go down, guess what your bank is going to do? They're going to reduce the amount that they're paying you on your deposits immediately. Meaning that now is not a bad time to consider locking in these higher interest rates. Now, if you have a $50,000 emergency fund, what I'm not saying is that you want to go out and buy a 2-year CD with $50,000. Because guess what? That defeats the purpose of having the emergency fund. That violates one of our 3 rules of being liquid and ready available cash to you at all times. But maybe you have your $50,000 emergency fund. Maybe you have another $25,000 sitting around not doing a whole lot for you. Now is a pretty good environment to consider going out and buying a CD over 6 months, 12 months, 24 months, and locking in these higher interest rates now while they're still available. Because again, they're more likely to go down than up, we think, at this point. And when they go down, your bank is going to reduce your rate immediately. So takeaways for today: emergency fund is the most important first thing that we need to think about with our financial planning. And once you have that started or in place, we need to scrutinize the rate that you're getting on that cash. It needs to be ready and available to you at all times. It needs to be covered by the FDIC. So if your bank goes out of business, the federal government will come in and reimburse you and give you your cash back, which seems like an unlikely thing, but guess what? It happened to 3 different banks last year. And there's concerns about several more right now. So we need our cash to be FDIC covered, and we want to get the best rate that we possibly can. If you have extra cash, because rates are more likely to go down than they are to go up, we think at this point, it's not a bad time to think about locking in those rates by buying a CD. An alternative would be a U.S. government bill, or maybe a 2, 3, 5-year note, a U.S. government bond, or even a corporate bond is not a bad thing to consider there too. But that's what we need to be aware of. We need to have our emergency fund. It needs to be ready for us. Get a decent amount of rate, and if you get a decent rate on that cash, and if you have extra cash on top of that, you might want to lock in the rates now, because when they go down, that means that we'll be getting less in interest on our deposits. I hope you liked today's video. If you did, make sure to hit the like button at the bottom of the screen and subscribe to the channel to make sure that you're notified anytime we come out with something new. On top of that, if you're not sure whether you're on track financially, you might want to check out our free wealth gauge assessment. There's a link for it in the comments. Basically, you click the link, you take 3 minutes to fill out some basic financial information about yourself. We take that information and run it through our financial planning software. Then we send you via email a short private video of our findings and 30,000 foot observations.